This year on the ESG side, we saw significant rating increases. The likes of MSCI increased Ryanair's rating to an A from a triple B. The Carbon Disclosure Project increased our rating to A-, which is something that we've been trying to achieve for the last number of years. And Sustainalytics kept us as the number one rated airline in Europe for ESG. On the technology side, we saw another 48 game-changer aircraft enter into the fleet this year. These aircraft, to put it in context, 4% more seats, but 16% more fuel efficient, 40% more noise efficient. And we also invested heavily in the retrofit of scimitar winglets onto our NG fleet, where we now have 25% of that fleet retrofitted for this summer, delivering 1.5% fuel and CO2 savings, 6% quieter, and we'd hope to have the whole programme rolled out to our 409 NGs over the course of the next couple of years. And then the final progress that I'd like to report is in relation to sustainable aviation fuels, where we've continued to partner with key fuel companies in big markets all across Europe. So while we have an aggressive target of fueling 12.5% of our flights with SAF by 2030, we now have secured 10% of that volume, which I think is a great achievement at this stage.
What's your latest EU ownership figure?
Yeah, I'm pleased to report that over the last 12 months we've seen EU ownership rise from 46% to 48% as at the end of March 2024. We're getting very close to the 50% threshold, and I think that's important because what we plan to do is to reinstate voting rights for all shareholders once we get the EU ownership back over that 50% threshold, and I hope that will be shortly.
Moving to your fleet, what's the latest update on game-changer deliveries?
Well, we had 146 game changers in the fleet at the end of March. We'd hope to grow that to somewhere close to between 158, 160 by the end of July, leaving us, plus or minus 20 aircraft short for the peak summer period. But we're working very closely with the Boeing team, Stephanie Pope, Brian West, Dave Calhoun, and we'll take deliveries throughout the summer period all the way through to the end of October, where we hope to have about 180, 181 aircraft in the fleet. And then at that stage, we'll focus very much on the final 29 deliveries into the spring of next year, so that we've got 210 game changers for next summer. We've also supplemented our traffic into next year by extending 3 Lauda leases, which would otherwise have been handed back to lessors this winter. We did so on attractive lease terms.
Will you receive compensation for the Boeing delivery delays?
We will, but the compensation is modest and clearly subject to confidentiality. It doesn't reflect the quantum of the losses that we will suffer this year as a result of having to cut back our traffic growth from 205 million to 198 to 200 million passengers. Our focus, though, and that of Boeing, is on accelerating those aircraft deliveries, recovering the delivery delays, getting the 59 aircraft deliveries in here by the end of October, end of November, and then moving straight away on to ensuring that Boeing deliver the 29 contracted deliveries between January and April of 2025, so that we underpin strong traffic growth through summer 2025 into financial year 26.
When do you expect the MAX 10 to be certified?
We need to first see the MAX 7 certified, and then the 10 will come a few months after that. So the way things are tracking at the moment, we understand that the 7 should hopefully be certified, if not at the back end of calendar 24, then into early 2025. That would then mean that the MAX 10 could be certified somewhere, hopefully, in the first half of calendar 2025. I think the launch customers in the US would then fly both aircraft next year, which will put us well on track to receive our first MAX 10 into the first half, so the spring of 2027.
Michael, looking at your summer 24 schedule, what are the key call-outs?
A very exciting growth plan all summer long. We're opening over 200 new routes this summer. We're opening 5 new bases in Copenhagen, Dubrovnik, Reggio Calabria, Trieste and Tangier in Morocco. That growth is strong. Forward bookings are strong, although the pricing is a little bit weaker than we had thought. We think that growth will be underpinned by continued intra-EU capacity constraints for the reasons we've already set out. And we see positive demand into summer 2024. Pricing at this stage a little bit weaker than we expected into April, May and June. But at the moment, forward bookings and pricing look strong, well ahead of 2023 for the peak months of July and August.
What's your view on intra-European capacity over the next few years?
Oh, I think it's going to continue to be constrained. We saw a structural change in capacity throughout COVID. A lot of capacity came out over the past few years. The M&A story is starting to play out in Europe as well, with the likes of the ITA, Lufthansa and the IAG Air Europa deal going through competition approval at the moment. TAP likely to be up for sale in the next number of months as well. Closer in, and this summer we're going to see a lot of A320 capacity grounded due to the Pratt & Whitney GTF engine issues. That's not going to go away quickly. That's likely to roll out to at least 2026. And then we've got the ongoing OEM delivery delays, both Boeing and Airbus behind on their deliveries and not likely to catch up this side of the 2030s. At the same time, we're taking delivery of game changers. We'd hope to have 210 game changers in our fleet for next summer. And then we've got our 300 MAX 10 order between 27 and 2034, which is going to enable us to grow to 300 million passengers over the next decade.
Moving to current trading, how are summer 24 bookings and fares tracking?
As we've already said, we see demand is positive into summer 2024. Pricing in Q1 is a little bit weaker than we had expected. Pricing at this early stage for Q2 looks to be a little bit stronger, but the visibility is limited and therefore the outcome depends entirely on the close-in fares for bookings through the three peak summer months of July, August and September. I think at this stage we're cautiously optimistic that summer 2024 fares will be flat to modestly up on summer 2023, despite almost 9% capacity growth in Ryanair.
Neil, switching to your results, you reported a PAT of 1.92 billion. What were the key drivers?
Yeah, we saw a 9% increase in our traffic to just under 184 million passengers this year. It was very strong performance despite the Boeing delivery delays. Average fares put in a good performance, up 21%, driven by a record H1 last summer. We also had a very strong March just gone, where we enjoyed most of Easter in that. That was offset somewhat by the OTAs taking Ryanair flights off sale in December of last year, so in Q3, which impacted fares and loads in that quarter. Ancillaries put in a very solid performance, up 3% per passenger to just over €23.40 in the year. So we had a strong revenue performance on costs. We saw a 24% increase in costs, driven primarily by a 32% increase in our fuel bill, so an extra 1.25 billion onto our fuel bill in the year just gone. We also saw staff costs increase as we had a full year of pay restoration. We increased investment in crew resilience and crewing ratios, some of that down to the late delivery of Boeing, and then we saw some handling increases. But I think the key thing is that the cost advantage between Ryanair and everyone else is supreme. We continue to widen the cost gap, and this has been further supplemented by the strong net interest income in the group, and we would expect that to continue for some time to come.
What's your current fuel hedging position?
Yeah, we're 70% hedged for the full year out to March 2025 at about $79 a barrel. That's about a €450 million saving over last year's hedged fuel rate, which was $89 a barrel. And it's interesting, in recent months we've seen some weakness into FY26, and we're now 10% hedged into FY26 at about $79 a barrel as well.
What about your OPEX currency hedging?
Yeah, on the fuel OPEX, we're well hedged, just over 80% at this point in time, at 1.11 on the euro dollar.
Is carbon hedged?
Yes, the full year 2025 carbon exposure is fully hedged at 76 euros per credit.
Switching to your balance sheet, what are the highlights?
Yeah, it's an industry-leading balance sheet with a very strong investment grade rating, BBB+ from both Fitch and S&P. I'd point towards our strong gross cash at year-end, 4.1 billion, despite the fact that we 2.4 billion in capex and well over $1 billion in debt repayments. Net debt very strong, so up from 600 million last year to 1.4 billion at the end of this year, although it was somewhat flattered by delivery delays, which will now time into FY25. I think importantly and uniquely, however, Ryanair owns all of its aircraft. We've got 556 Boeing 737s fully unencumbered on our balance sheet at the end of the last financial year in March. And this is a unique advantage because it means at a time when our competitors are out there taking on very expensive leases due to a shortage of capacity and raising very expensive bonds, as we've seen over the past couple of weeks, Ryanair is able to fund itself out of its own cash resources and has huge flexibility due to the unencumbered fleet.
What is your CapEx guidance for FY25 and FY26?
Yeah, due to the Boeing delivery delays, gross capex for FY25 will be about 2.3 billion euros, with no aircraft deliveries then scheduled in 2025 and 2026. We expect FY26 capex to fall to approximately €1 billion. So significant capex savings for the next 2 years with no aircraft deliveries.
How will you fund the aircraft capex?
Well, with the strong cash balances that we have and in a rising interest rate environment, it makes sense to use our own cash. But we can be flexible and we will be opportunistic in what we do. I mean, it'll ultimately boil down to what's the lowest form of financing at any given time. And thanks to our strong investment grade ratings and our unencumbered fleet, we can choose from everything, whether it's bank debt, bonds, JOLCOs. But at the moment, cash is the way to go.
Michael, moving to the OTAs, what's the latest update here?
Well, I think the relationship with our OTAs has been transformed in the last 4 or 5 months. We've signed up probably 8 of the 11 or 12 largest OTAs, online travel agents, to our approved OTA distribution. This gives those OTAs direct access into the Ryanair.com website. They no longer have to pay intermediaries to scrape our website. That's a significant saving for them. They also guarantee that they'll give the consumers the real Ryanair prices for airfares and for ancillaries. They're free if they wanted to charge a separate fee for that service. That's a matter between them and their customer. But what's critical for us is we protect consumers by ensuring they get real Ryanair prices for fares and ancillaries, and Ryanair gets the real payment details and the real customer information details. So if we need to communicate with those passengers, flight information, safety information, disruption information, we can do so without having some intermediary in the middle. Regrettably, the only large OTA online travel agency pirate still in existence is eDreams in Spain, who are continuing to scam our customers for inflated airfares, inflated ancillary services, and they've also introduced this new eDreams Prime service where they persuade people to subscribe for €65 a year and then deliver them no benefits whatsoever if they're booking Ryanair flights or ancillaries. It's a scam. We've reported to the Spanish Consumer Ministry, to the EU consumer agencies, and we expect and hope that they'll take action to outlaw the consumer overcharging and scamming, which is at the heart of what in my mind is the broken eDreams OTA pirate model.
What are the longer-term benefits of removing unapproved OTAs?
Well, as Michael already said, the real winner from this is the consumer. They're no longer being overcharged. They've got full transparency in what's happening. And then more on the day-to-day operational side of things, because we're not getting fake email addresses, because we're not getting fake payment details, it means that if there is a schedule change, if there's a cancellation, if somebody needs a refund, we're now able to deal with the customer directly and process things in a very efficient manner. And they're not missing flights that they should otherwise have been informed about.
Switching to shareholder returns, the board approved a dividend policy in November. Any further update?
No, we've gone ahead with that. The policy is to pay out about 25% of net after-tax profits in the following calendar year. In calendar 2024, we're paying about 400 million in dividends. 200 million was paid in February. We expect the balance of 200 million to be paid in September after the AGM. And based on this year's profitability, I think it's reasonable for shareholders to assume and expect that the board will declare a dividend of 480 million payable in calendar 2025, again, half in February and half in November. So we're living up to our commitment that once we can secure or we can generate additional spare cash, we will return that to shareholders, but only after, first, we've looked after our people, secondly, we paid down our debt, and thirdly, we have funded what our ambitious CapEx programmes.
You announced a €700 million share buyback this morning. What are the details?
Yeah, in line with our capital allocation policy, we feel we've hit a number of the key targets that we have in mind: debt repayment, capex funding, and the restoration of pay and pay increases for our people. So the board we're pleased this morning to announce that we're going to launch a 700 million share buyback. That will formally launch later this week in the open period. It'll run for a number of months, probably out towards the half year in November. And when that's complete, we'll have returned just under 8 billion to our shareholders since 2008.
Could you give more colour on how the buyback will be deployed between ORDs and ADRs?
I mean, it makes sense for us. You know, it'll be split between EU shareholders and non-EU shareholders. That will also include the ADRs, despite the fact that the premium is about 30% at the moment. We do plan to try to secure blocks of ADRs. We do need to balance the share buybacks so that we can continue to maintain a growing EU share ownership. We want to get from 48% up to 50% over the next 12 months. But as part of that buyback, we will consider blocks of ordinaries that are held by non-EU holders, particularly pre-Brexit UK holders, and also holders of the ADRs within the confines of the AGM buyback authority to enhance our EU share ownership.
And lastly, what is the group's FY25 outlook?
Yeah, just to sum up, we would target traffic growing by at least 8%, so somewhere between 198 and 200 million passengers this year, subject to Boeing delivery delays. Unit costs will remain in good shape, so we expect the cost advantage between ourselves and everybody else to widen with modest unit cost ex-fuel inflation offset more or less by our positive fuel hedging and our net interest income increases. On fares, we'll remain load active, yield passive, so we'll hit the passenger target and price accordingly. We have noticed softer pricing despite the capacity constraint in the market at the moment, and we've been stimulating into Q1. At this stage, with limited visibility, however, we do think that peak summer fares will be somewhere between flat and modestly up despite the growth this year. So look, it's too early to give meaningful or accurate PAT guidance. We'll update as the year goes on, but I think the key is that we've got a very strong balance sheet, we've got a very low cost base, we've got an order book that's going to enable us to grow to 300 million passengers over the next number of years, and we're returning funds to our shareholders.
Michael, Neil, thank you.
Thanks, Peter. Thank you, Neil. And by the way, ladies and gentlemen, we have an extensive roadshow underway this week. We have 12 teams of the management touring through Ireland, the UK, continental Europe, and also both the east and west coast of America. If anybody would like a meeting, please contact us either through Citigroup, through our brokers, Davies or Goodbody's here in Dublin, or through our investor relations function headed by Peter Larkin. We'd be happy to meet you wherever you are and brief you on the Ryanair story. I think it's one of exciting growth, certainly exciting delivery, widening cost gap over our competitors, and we stand on the threshold of taking 300 Boeing 737 MAX 10 aircraft that will transform our operating economics, will widen the cost advantage leadership over every other EU airline, and we think will generate profitable growth for us out to the mid-2030s. Thank you very much. Look forward to meeting you later on this week.